Welcome, everyone, and thank you for joining us for our annual Financing Trends webinar. I'm Kirsten Loita of Osage University Partners, and I head up our university relations efforts here at OUP. I'm going to be our moderator for our discussion today, but going to the next slide, I'm really happy to be joined by two of my colleagues, Bill and Allen. I'm going to have the team introduce themselves. Bill, can you go first?
Thanks, Kirsten. Hi, everybody. My name's Bill Harrington, one of the managing partners here at OUP, along with Matt Cohen. I manage our life science activities. I am an MD originally, been in venture for 25 years.
Great. Thanks, Bill, for joining us today. Allen.
Hi everyone, my name is Allen Chen. I'm one of the principals on the technology team based in New York. I have about 5 years investment experience in venture capital. Nice to meet everyone.
Yes, and so happy to have you here for your inaugural webinar with us, Alan, as well. I do need to give a quick shout out to one of our team members, Nabil Ula, who researched and created a lot of the slides that are associated with this deck today. Thank you so much, Nabil, for putting most of this together. Before we dive into our discussion, we'll go to the next slide. I do want to mention a few logistics to everyone who's joining us today. We are recording this webinar, and that will be available both on OUP's partner portal, which is available to our partner institutions. You just go under the resources and OUP webinars area to find it there. It will also be available on our YouTube channel. You have QR codes on this slide to gain access to both of those. Again, the partner portal is only available to people at our partner institutions. We will be sending out both the recording and the deck to everyone who registered for the webinar today. So don't worry, you'll also receive the information through that. So look for a follow-up link either later this week or early next week for all of that. We do have a couple of other webinars coming up on April 30th. We have the legal needs of early stage academic startups. We'll be having attorneys from both Mintz Levin and Wilson Sonsini, Goodrich and Rosati joining us for that particular webinar. And then we're currently also working on a webinar about venture debt and how that works with startups. So look out for more information on those coming up. I will note that we really do enjoy Q&A in our webinars, so please do ask your questions as they come up on the particular topic that we are talking about. Use the Q&A tool in your toolbar that you can see in your Zoom screen down below. So I'll be moderating those questions and asking them as appropriate to our panelists. So we'll go to the next slide. I do want to give a short intro on OUP for those of you who do not know us. We're a venture capital fund that partners with academic institutions to invest in their startups, typically by exercising participation rights that are available through their licenses. For those who don't know what participation rights are, they are the ability to invest in future rounds of a company on the same terms and conditions as other investors. We do have recommended language with regards to participation rights, so if you are wondering about that, please just reach out to me and I'm happy to tell you more. So as part of this partnership that we have with academic institutions, the academic institutions share in a portion of our profits and also receive programmatic support on technology transfer and academic startups. We're now, OUP is now on its fourth fund. We're very proud of that. We've made investments in over 150 companies in all areas of deep science that we'll talk more about on the next slide. And many of those companies have achieved successful exits at this point. So this slide just gives you an idea of the different areas that we have invested in and are of interest to us. We're always happy to talk more about our model and our areas of interest. So feel free to reach out to us at any time. At the end of this deck, there will be contact information for all of us. So with that, we will go to our next slide. This just shows our agenda for today. We'll talk a little bit about the state of the current fundraising environment, obviously a topic of large interest to all stages of startups. And it's been a roller coaster for a little while here. So we'll start off with that. Then Bill will go into our life science trends. Alan will go into trends that we're seeing in the tech and physical sciences environment. And then we'll just do a quick wrap up and go into that Q&A that we mentioned before. So with that, I will pass it over to Bill to talk about the first slide associated with the state of the fundraising environment.
Thank you, Kirsten. And as Kirsten said, please feel free to ask questions as we go using the chat feature, and Kirsten will pass those along real time. So there are really two forces shaping the current venture environment and providing kind of the backdrop for some of the fundraising challenges or opportunities that we see today. I'll talk about one, Alan will talk about another, and then we will explore how these roll into life science and tech environments in some detail. The first is this idea of a liquidity gap. We spoke about this at the summit in October. It has gotten a little worse, not better. And there are multiple layers to this concept. The idea is money goes in, money comes out, and you need the liquidity of money coming out to fund new investments. And at the venture fund level, VCs have been investing in companies for a long time. And other than the blip in 2021, kind of the COVID euphoria, where we saw a lot of exit activity, it has been pretty bleak since then. So companies have been making great progress, but the IPO markets have largely been closed, with some exceptions we'll talk about, and M&A activity has been dampened. As a result, venture funds are required now to continue to fund their portfolio companies for longer and to a greater extent than they originally thought and modeled. The limited partners, who are the investors in the venture funds, because it is a food chain, are not seeing the distributions from the venture funds that they had modeled into their financial projections. So they now have less capital available to pledge and invest in venture funds. So it's a bit of a downward spiral. And the negative outcome of that is just there's less capital available for new investments by venture funds, and that we have seen as as driving some challenges in the current fundraising environment. It's uneven across sectors, and that's what we will explore throughout the most of this talk today. You can see that there was some increase in 2025. There's a thought that that may increase again in 26, although there are some macro factors, as we're all aware, that are kind of impacting the investment environment and creating more of a risk-off environment right now. But, we are seeing some bright spots in AI, crypto, cyber, and related technologies, which are driving kind of the uptick you see here in 2025. Not true in life science, and we'll spend a little bit more time on that. But this gap between dollars in and dollars out continues to really underpin some of the fundamental challenges we're seeing in the fundraising environment today. Alan, do you want to talk about the next one?
Yeah, sounds good. And so this slide probably is no surprise for y'all. The talk of the town in venture capital has been AI. And you can see from this chart in the middle here just how much investments have risen in just this one bucket. From 2024 to 2025, AI investments doubled to 221 billion, almost the same value as the exits that were achieved in 2025. That made up nearly 65% of all the VC dollars in 2025, which is a drastic increase compared to what happened in 2015. If you look at 2015, only about 10% of deal value was going into AI. What's interesting is also the rise in the valuations and the round sizes within these AI companies. You can see on the right side chart, it's a little bit muted, but the median sort of valuation for AI companies is rising. It rose from 27 million to 46 million. And then meanwhile, the average pre-money valuation has sharply increased from 358 million to 1.2 billion pre-money valuation. So that just shows you sort of how concentrated some of these rounds are. A few sort of that we call out here are Anthropic. You probably saw them raise a $15 billion raise. I think OpenAI just raised a 100 billion plus round in Project Prometheus, which is Jeff Bezos' most recent AI project, raised a 6.2 billion first round seed financing. And so overall, we're seeing a lot of investor euphoria in this just one category. And that's driven by a few areas, right? One is certainly we are seeing massive adoption across both the consumer and the B2B, so B2C and B2B channels for AI. With these adoption of AI tools, there are realized labor savings as well as productivity gains that we're seeing with these AI tools, whether it's in code development, some of you may have already tried Claude Code or Cursor, as well as for chip design. How do you leverage AI to, compress the development cycles for new chips? And so we're starting to see AI not just, capture what's traditional software dollars, so software spend in a company's sort of cost bucket, but also labor spend. It's actually influencing how companies are planning their workforce. I think the other piece that you're seeing where AI dollars is flowing is in the infrastructure side, right? All this AI compute needs to be powered by the supporting GPUs and also CPUs within these data centers, like AWS, Microsoft Azure, and there's tremendous appetite from those players to invest in the next generation of AI infra, whether it be the chips themselves, but also supporting photonic systems, power management tools, interconnects. And so not just investment in software, but also investment in AI hardware. Um, that being said, right, a lot of this is still sort of, speculation, right? There's a lot of valuation here that is sort of being built on expected value in the near future. And so the story is still to be true, to be told whether the valuations that are being built here will realize into enterprise value. With that, we're going to go into more detail, but I'll pass it over to Bill first to kind of go through trends in life sciences.
All right. So let's dig in on life sciences and we'll kind of divvy it up. We'll start off general and then divvy it up into some of these subsectors as time goes on. The sources for all of these data are footnoted in the bottom of each slide. So if anyone has any questions on where the data comes from or what's really underlying it, we're happy to get you the original source information. Looking at healthcare across all sectors, and we, as most investors, kind of divided broadly into four sectors. We ignore healthcare services for now. And you can see the trends over time. Obviously, there was in a buoyant period during COVID when there was a lot of money going in to biotech, particularly, and health tech broadly. That has come down pretty significantly. You can see biotech in particular is down quite a bit. Diagnostics and tools considerably. Devices is kind of holding its own. But overall, they kind of move together. And it's biotech and health tech that have seen the most significant changes over time. You can see the numbers of deals kind of varies a little bit, not a lot. But if you exclude kind of the outlier data from late 20 through early 22, it's been a pretty consistent investment pattern. Varies a little bit between and among sectors, but there was a buoyant period, a little bit of a depression, and then kind of back to steady state. Next slide. If we look at biotech in particular, the number of deals is dropping. The size of these deals, particularly looking at Series A on the right, is gradually going up. It's a little bit of a situation of haves and have-nots. Companies that are being founded by repeat entrepreneurial teams or are chasing very exciting biology are finding lots of investors and oversubscribed syndicates and high valuations. Everyone else is really struggling. If you look across the various rounds going back to 2022, so now we're past the 2020 COVID extremes, you can see things vary a little bit up and down. I wouldn't pay too much attention to first half, second half numbers because they do tend to even out over time. But I think the takeaway here is, we've tried to break this down in a fairly granular fashion. I think the overall message is, there's a little bit of a downturn in biotech, but overall it's largely consistent. And once you exclude kind of the COVID extremes, the one message and one consistent thing we're seeing is that valuations are going up, size of the rounds has increased a bit. So it's really a tale of haves and have-nots. So, I think the message to founders is you want to be in that haves bucket. So really think hard about what you have, what your value proposition is before you approach investors. Can we move on? Now, looking at universities in particular, and we define university biopharma as kind of any connection to university origination, not necessarily licensed technology. This accounts for about half of all biotech. If you look on the prior slide, these numbers are about half of what we saw there. So it's a meaningful participant in the biopharma space. And, interestingly, those companies that have a connection to universities are actually outperforming the broader market. University spin-out investment actually increased slightly in 2025. The number of deals is down a little bit. And on the right, as we saw with the broader market, the size of these Series A deals getting larger, both pre-money valuation and the size of the amount of money being raised. So again, it's a little bit of a haves and have-nots, but at least in the university-connected biopharma ecosystem, there are more haves than in the broader market. So I think, it does go to the underlying premise that most of the really interesting technology in biotech, biopharma traces its origin to a university lab. And we're seeing that reflected in deal mechanics, size, and number. Looking now early in the process, so seed and angel investments. So these are pre-Series A investments. I think a lot of you deal with this on a day in, day out basis, trying to get these companies their initial capital. Seed deals continue to decrease. Seed deal count is down quite a bit. The 2024 number, I think, although it's accurate, is skewed high by a couple of very large kind of atypical seed deals, but no question 2025 saw a drop in the number and dollars going into seed investments. That's largely a byproduct of being somewhat of a risk-off environment and seed deals being viewed as exceptionally risky, particularly at a time when the non-seed deals, the Series A and later financings, are finding it more challenging and dividing the world into haves and have-nots. I think for most investors, they're finding seed deals just to be too risky in the current environment. The interesting feature is the deals that are done or were done when we look at the average deal size is holding steady, low single digit valuation, low single digit financing size. So it's really more a matter of fewer deals getting done than some downward pressure on pricing or dollars being invested. Next slide. Okay, moving from biotech to medtech, we see a little more resilience. The numbers here are obviously quite a bit smaller than in biopharma. And, medtech here is broadly defined. This is the SBB data from their annual report. And included in here are kind of more tech-enabled devices, robotics, AI-enabled technologies, and bringing in investors that are, not traditional medtech investors. And we're seeing that across the medtech segment. But if here, again, you look at the breakout of seed, Series A, B, C, the numbers move around a little bit. They're not dramatically different. The second half of last year, there was a risk off. The number is smaller. I'm not sure that I'd make too much of that. It is accurate. And again, you see, as opposed to biotech, over the last 5 or 6 years, the size of these deals has generally been stable in Series A. And, the pre-money, the amount of money raised is pretty stable. The number of deals, I would posit, hasn't really changed pretty dramatically. So devices is kind of steady as she goes. I don't know about that stumble in the second half of last year, whether that's going to carry forward through 2026 or not. Again, there are a number of macro events that are impacting the risk environment, and that will translate into some of these venture numbers. But historically, anyway, the medtech activity has been fairly consistent. I think the one other factor that we're starting to see creep into decision making is the unpredictability at the FDA. It's been in the press quite a bit with vaccines and gene therapy, but it's really across the agency, in medical devices, in all form of biopharma, where goalposts are moving. A lot of talent has left the agency, and new folks taking their place really aren't as skilled, aren't as experienced, and are trying to start over. So I think for a number of investors, particularly in medtech, there's been a pullback from companies that are still facing meaningful regulatory risk, and a sense that, hey, let's let this chaos die down a little bit, wait till you have your approval before we're going to invest, or at least have a very clear understanding of what is required, because those goalposts have been moving. That could be a problem for the foreseeable future, or depending on how leadership shakes out, that could be something that we get a little more clarity on. But it's a major uncertainty, particularly in devices right now, but also in biopharma. And in the bottom here, you can see we talk about some of the areas that have been bright spots. Not surprisingly, they are areas where tech and med tech and biology intersect. So AI-enabled anything has become very popular. A lot of the investors that are investing in these segments and these companies are not traditional medical device investors, whether it's Google or Amazon or Khosla, and you'll see a list of investors later. A number of these groups have really started to build out medical device, medical tech investment groups to take advantage of that growing intersection between technology and biology. Next slide. Now turning from the broad category to university specific. Interestingly, although most med tech deals don't originate in universities or with university technology, those that do have been surprisingly resilient through this kind of uncertain last few years. You can see the numbers here. I won't repeat them, but other than the blip in 2021, it's been pretty steady for university-connected medical technologies. I think part of this is we're seeing more activity in universities bringing together various AI and sort of separate technologies and into an interaction with biology and more traditional medical devices. If you peel back the onion here a little bit and look at what these medical device spinouts really are, it's fewer cardiac valves and traditional kind of what we think of as medical devices, and more technologies that have major impact on biology. And we're seeing more and more of that as the years go by. And I think that's just the beginning of it can be a major trend and maybe a new category that we have to start thinking about. The valuations here have risen considerably. That's because these tech-enabled companies are raising a lot more money at higher prices with new investors who are willing to pay up, whereas traditional medical device investors typically are not. I think when you're looking at Google Ventures or AWS, and they're looking at healthcare applications for some of the technologies that they have traditionally invested in, they're bringing a different valuation sensibility, and that's being reflected in deal sizes. And it's really intersecting universities before and to a greater extent than the broader market. Let's see, next slide. Unfortunately, given the buoyancy in university biotech and the resilience in medical devices, diagnostics, and tools, which we lump together but are really different, are really starting to see a continued and even steeper downturn. We've been talking about this at our various OUP meetings for a while, that diagnostics, particularly reimbursement in diagnostics, has been super challenging and has led to a pullback in investment capital. Diagnostics and tools, research tools, there's a lot of activity in university around research tools. Again, the commercial opportunity has been difficult to prove. The onesie, twosie test use cases are fine, but that has not translated into broad adoption. And that has caused venture firms to start thinking twice about both diagnostics and tools. Regulatory issues are starting to surface In the diagnostic area, again, you're hitting a somewhat dysfunctional FDA, which is just causing people to pause. And then reimbursement for diagnostics is continuing to be a challenge. I think the numbers on the right looking at Series A valuations are a little bit all over the map. Some of the research tools are in genetic testing, and you're seeing some fairly large deals getting done by strategic investors that already have a presence in broad genetic testing technologies. That's sort of, I think, skewing the market a little bit. So the 2025 numbers are a little bit skewed. I think the trend overall is smaller deals and fewer deals. And again, AI is starting to make its way into, particularly into the research tools area, to some extent into diagnostics, and you're going to see that inflate valuations going forward. The question is whether those deals will ever pay off. I think that still remains to be seen. But for traditional VCs, this is still an area that I think most people are kind of holding back on, and the data support that. Katie, next slide. They now turning from the broader market to university specific information and data, it's not really any different here. Whereas in biotech and devices, the universities, I think, outshine the broader markets. In diagnostics and tools, I think they are suffering along with everybody else. There's less money going into university companies in this sector. The valuations are up. That probably reflects a little bit of an AI premium in the tools segment of this data set. But overall, talking to other investors kind of day to day, there's just not much of an appetite here. And I think that's reflected in these numbers and trends. That's been going on for a while. Next slide. So we'll just finish with this. If you look across these sectors, there's a couple of takeaways here. In biotech, it's the usual suspects, and there are a lot more that aren't listed here. And these are groups that are pretty active across all segments and sectors in biotech. In medical device, the group to the far right, USVP down to Gilda, those are the traditional medtech investors that have been around for a long time. And now we're starting to see more tech focused investors getting into the device area, particularly where AI and some of the new technologies are being brought to bear on biology and clinical problems. Health tech is kind of a who's who of high tech investors, really not medical investors so much. And a lot of those groups now have developed life science specialty groups within them to try to focus on this. And then diagnostics and tools, kind of a grab bag. Nobody's really that active right now. But those are the investors that are making the investments. So, the landscape is changing. I think we're seeing tech investors getting into life science to a greater extent, primarily in AI and tech-enabled medical devices, but also to some extent even in biotech, and certainly in the broader areas of health tech and research tools. So with that, I think I'll turn it over to Alan to take us through what's going on in tech and physical sciences.
All right. Thanks, Bill. So we're going to talk about tech and physical sciences. And we kind of went through a little overview of the AI. So, part of this discussion is going to be sort of what's going on beyond AI. So this slide here kind of, peeks down a higher level and sort of how tech investments have trended over the past 10 years. You can see here, from 2015 towards 2021, there was a buildup in VC activity in both deal value and also deal count. A lot of this was driven by, reducing interest rates, around 2020, 2021. There was also this whole SPAC activity, right, that was happening that created a lot of exits and excitement, which also inflated valuations and round sizes. That corrected itself, right, in 2021 through 2023, where there were a lot of down rounds, there were a lot of flat rounds, and companies struggled to raise capital. Deal count commensurately also fell. Now, if you look at sort of between 2023 and 2025, we've been on this sort of, gradual recovery, I'll call it that, where most of the recovery has been driven by investments in AI, right? We're almost pretty much back at that 2021 period in deal value with about 300 billion spent. I think if we just looked at deal value on this chart, I don't think that would tell the full story. I think there's a couple other dimensions that we want to unpack, right? The first is sort of that orange line you see here, where it basically shows that deal count has been relatively flat and almost declining. And so it is a game similar to what Bill mentioned of games of haves and have-nots. It's difficult to raise capital, right? Unless you're AI. Even if you are an AI company, it's also a very competitive process. You're fighting against other sort of lookalikes and clones, and you got to demonstrate your differentiability. And so we're seeing deal count go down. And so commensurately, your average pre-money valuation is going up. On the right side, you can see sort of the distribution of deal value by deal size, right? In 2020, from 2010 to 2020, the sort of the distribution was mostly concentrated around $100 million round sizes. Flash forward to what happened last year, you're seeing only 30% of deals happening under 100 million, and almost nearly the majority of deals happening over 500 million, right? These are mega rounds that are being raised by companies I mentioned prior, like Anthropic, OpenAI, Databricks. Round sizes that we've never seen before in the private markets are happening right now and keeping these companies privates. Sort of another sort of statistic to underpin that is that 50% of the total value under here represented only 0.05% of total deals in 2025. So again, a huge bifurcation sort of deals that are happening between the mega rounds and the smaller rounds. Now, if we stripped out the sort of the AI companies out of this left-hand side chart, what would it look like? It'll probably show that non-AI sort of companies and their deal value and deal count has been flat, right? Non-AI deals were relatively flat, about 5 to 10% growth in 2024, but still not nearly the doubling of deal value that happened within AI specific companies. Next slide. So this slide, we're going to just talk about deal exits, right? We talked a little bit about this earlier on a broad scheme, but here peeking into tech, you'll see that, on a quarterly basis, we still haven't recovered, back to the 2021 days where, most of the exits were driven by public listings slash SPACs. What you are seeing in the, more recent, call it 2 years, have been an increase in acquisitions, which have been driving most of the exit activity within tech. Some of these are sort of pure play acquisitions. For example, Celestial AI was acquired um, by Marvell recently for about $3 billion, right? You saw that Wiz had a massive acquisition by Google for 30 billion plus, right, last year. But you're also seeing a new kind of acquisition, and you might have heard this term called reverse acquihires. These are examples like Scale, which was famously acquired by Meta for about 14 billion, and Grok most recently, which was acquired by Nvidia for 20 billion. And these are not pure play acquisitions. They're instead where the company is purely hiring the key select talent from the target company while gaining exclusive license to that company while keeping the shell company intact. And why are they doing that is sort of the next question is, I mean, really it's because it's fast. It allows them to quickly hire the talent in which otherwise they would need to find and hire separately. And also, it's a way to eschew the typical regulatory process and antitrust scrutiny that comes with some of these traditional mergers. So we're seeing a lot of activity happening there. On the right-hand side, you'll see that actually a lot of these acquisitions are happening earlier in a company's life cycle, right? That's sort of that dark sort of maroon color represents the percentage of seed companies that are actually acquired that year. And you can see that that is rapidly increasing. And why is this happening is really because there's a acceleration or the name of the game in AI is speed, and there's incredible competition that's happening in this landscape where companies are forced to acquire versus I guess hire and build the capabilities themselves. So they prefer to hire quickly and acquire these capabilities versus investing in the engineering resources, and that's driving a lot of the acquisition to earlier instead of simply acquiring revenue. Next slide. And so this is sort of a double click into what's happening in the university world. And I would note that this data represents not just purely university licensed deals, but also ecosystem companies that are affiliated with university. And so the deal count and the deal value may be slightly larger than what is actually happening with spinouts. And you can see here the trend follows similar to sort of the broader tech market, but with the exception that 2025 is relatively flat from 2024. We're almost pretty much at the same period of investor deal value in 2021, and deal count is relatively flat as we described. A couple of sort of bright spots, right, is in physical sciences. You can see that on the right-hand side chart the pre-money valuation for physical sciences has increased. Deal sizes have increased, and also the pre-money valuation, which is a good proxy for how competitive these deals are also increasing. Um, these encompasses areas like quantum, it can encompass areas like fusion energy, but also robotics with all the activity that's happening around general purpose robotics and humanoids, as well as semiconductors, which we described earlier. All the technologies are going into your data center infra. The other piece, as we described before, is AI ML. That's also driving higher round sizes and higher pre-money valuation. So the average post-money valuation in 2025 was 158 compared to 120 in 2024. And so we're starting to see definitely investor interest pick up in these couple of areas. Next slide. So this is first time financing. So this is encompassing only that first time, pre-seed seed financing as compared to the subsequent larger rounds within university tech. And you see it on this chart. Actually, the growth has been pretty steady over the last 9 years since 2016. I think this represents that there is still interest among investors in backing early stage companies, right? These round sizes are naturally smaller, so there's less risk. There's purely a founder bet in a lot of these cases. But I would note that the deal count has still gone down. So there is a bit of this sort of flight to quality, the haves and the have-nots, and with the larger deal sizes only going to a select number of university companies, right? So the average deal size here, grew from 5.1 million, sort of first time financing round size, to 8.3 million average round size in 2025. Next slide. So now, what happens if we start to cut these university tech VC funding by segments? And here we did a simplistic sort of cut here between software and everything else, just to kind of keep it clean. And what's particularly interesting to see here is that software spend in 2025 encompassed almost half of all the investment into tech. That's compared to 2016, where it encompassed less than 25%. And there's a few different drivers for this. One is that this the CS and engineering departments have become a dominant sort of research output, especially in ML, large language models, and AI systems, right? It's easy for a PhD student to publish a novel training technique or inference optimization and spin that out as a software company. And it's also easy because of all these tools that we have today, with Claude, Code, and Cursor, for them to develop the technology, iterate on those proof points, reach those milestones so they can raise that next round much faster. And so we're seeing a lot more activity being spin up within software companies versus, let's say if you're developing a new semiconductor chip, that takes a lot longer time to build that company, to validate technology, to get investors sort of convinced. On the left-hand side chart, just to kind of cover this slide, you see that actually the blue dotted line is that represents early stage VC median deal size has been catching up to later stage VC. And that just shows you, I think, that these early stage rounds, call it Series A's, are getting a lot more competitive once you demonstrate the technology works. But also that it's a lot harder to raise these later stage VC rounds, right? These are becoming a lot smaller. And so we're starting to see those lines merge. Next slide. Now, we're going to go into a couple of sort of emerging areas that have been picking up investor interest. The first one I want to cover is defense tech. And some of you have already been seeing this in the news with companies like Anduril and Palantir, SpaceX, right? All these companies who I would consider as neoprimes that are challenging the traditional primes like Lockheed Martin, for example, in securing these large military contracts in the DoD. In the last, really just a year alone, we have seen increased investor appetite in this segment and what we call dual use technologies. Technologies that can be used both for, government customers like the DoD, but also for enterprise customers. Um, and in 2025, you see that there was about 21.4 billion that was poured into defense tech alone, up from 7.7 billion in 2024. Couple of factors driving this. Certainly one is that there is increased military spending across the different departments within the DoD. The second piece is sort of what I mentioned before, which is that all these sort of neoprimes are demonstrating their ability to win these contracts uh, against the traditional incumbents like Lockheed Martin, right? There is an increased appetite from the DoD to procure technologies from the neoprimes and back emerging technologies so they can modernize their technology stack. And so these are massive million-dollar contracts. And I think what this chart represents is that the VCs are starting to realize that, okay, there is sort of a venture outcome that can be also produced from companies serving the military. The other piece that is sort of not as obvious is that there's a bit of rotation of investor dollars. So whereas, climate tech, which we'll discuss in the next slide, has kind of fallen a little bit in terms of capital fundraising. A lot of those, oh, if we could stay on the next slide, the previous slide. Thank you. Whereas climate tech has fallen, a lot of those funds have actually rotated their capital to defense tech. So we're also seeing more funds starting to develop more thematic investing and shifting their spending into defense tech. Okay, let's move on to the next slide. So climate tech, if you asked me 3 years ago, sort of, what was the trend towards climate tech? A lot of the interest would have been underpinned by EVs adoption, right, and grid resiliency in terms of energy decarbonization. There was a lot of capital being poured here that was also being supported by non-diluted dollars from the administration. You can obviously see here on the left-hand side chart that in 2020, since 2021, climate tech deal value has started to fall and is really starting to fall in since the new administration has changed, right? We're seeing a pullback in the non-diluted dollars from the DOE. And we've also seen a lot of traditional climate tech investors rotate their own capital dedication and allocation into other areas like industrial resiliency and defense tech and also AI. But surprisingly, in the last year, climate tech has held up pretty steady. So, 2024, 2025 was relatively the same. But the caveat is that you see that sharp drop in deal count. So even though there was the same amount of dollars flowing into the sector, that was being spread across much fewer companies in publicly specific sectors that still had real economic value and real appetite from enterprise, right? Some of these sectors could be like critical minerals that was being supported by some of the geopolitical supply chain concerns, right? For rare earths, some of this could be also around infrastructure supporting clean energy for data centers, so adjacent to sort of the AI theme. Where less dollars have kind of poured in have been in areas like carbon capture, which has always been difficult to prove out the unit economics, into areas like solar, where it's been becoming more difficult to demonstrate um, differentiation from competing products, and also wind. Interestingly, on the exit value side, 2025 was a good year compared to the prior 3 years. There was about 27 billion that was exited, and that was a mix of both acquisitions and a couple of IPOs. So you saw companies like Crusoe raise a one. You saw companies like Fermi, sorry, and Beta Technologies IPO, and you also saw companies like Google acquiring Intersect Power for $4.75 billion. So we're still starting to see steady exit activity within climate tech, but only in certain niche areas. Next slide. And so maybe the question that you'd be wondering with all the talk around AI ML is this a bubble, right? Is this similar to what we saw in the dot-com era? Is this, what we're going to see, what we have seen in climate tech? Is this going to represent what we saw in the investor euphoria in the broader tech market in 2021? Will there be a correction, right? And I guess if you observe the past trends, I think we would be remiss if we didn't anticipate a correction, right? The market has drastically increase in deal value, and the pre-money valuation based in a lot of underlying assumptions for growth and the future pickup from enterprise customers. That being said, what we look at here at OUP is trying to understand, okay, where does the rubber meet the road in terms of AI ML technologies, these companies that are raising massive rounds, actually producing enterprise value and value that can be quantified, such as labor savings, for example, or labor productivity gains. And for us, I think there's a couple of sort of differences here. One is certainly that unlike the dot-com era, there are real rapidly growing revenue bases, right? Enterprise AI revenue in 2025 alone drew 37 billion, and that was 3x year over year. So I guess that's commensurate with what you're seeing in deal value in 2024. The other piece that we are thinking about is the massive amounts of capital that hyperscalers are pouring into the infrastructure side, right? These are hundreds of billion dollars of CapEx spend slash commitments that are being used to set the foundation for future AI applications for the next decade. And what this does is it increases the availability of compute first and foremost, but it also reduces the cost per compute. So it actually makes it cheaper and more economical for future companies to use AI to call, for example, OpenAI prompt. And so I think we're cautiously optimistic about where AI ML is going, but we also want to be very disciplined in terms of the companies that we're investing into and the valuations that we're coming into. And so our belief is that there probably will be a correction at some point, but AI ML has a lot of legs to stand on. And I think that was the last slide, so I'll pass it over to you, Kristen.
Great. Thank you so much. We'll take down the slides. We'll be sending these out to everyone afterwards. We do have a few questions that have come in, and if anyone else has questions, feel free to write them in as well. So I'm just going to answer the first one, which was, are these values adjusted at all for inflation? In general, no. The values that are published by reports and the things that we're tracking in our database are not adjusted for inflation. So there obviously is some incline that would happen over time. Anyways, if we adjusted if we didn't adjust for inflation, but I think the trends are obviously much more stark than inflation. So next question I'm going to ask of Bill. So are you seeing any interest again in platforms or in early stage financings, or is the bar still high? And is the kind of focus more still on assets that are closer to the clinic?
Yeah, I think it's the latter. We just had this conversation among a group of investors a couple weeks ago, and the I think temperament in the market now is kind of asset plays. We're seeing that coming out of China. Like big pharma is interested in assets now, generated in China, and those are asset plays. I think the platform, new biology platform coming out of a university that has a number of different applications and potential sources of new drug indications is less interesting because it takes a lot of money and time. And ultimately, you have to validate any platform by generating a drug from it. And quite frankly, generating multiple drugs from it to prove it's a platform. And that trend, I think, is only getting more significant and more pervasive, that investors want asset plays. Now, with that is the attendant risk of a rifle shot, that if your asset doesn't work or has a problem, you may be limited. So there are backups and ways to mitigate that risk. But overall, that is continuing to be a trend, if not increasing in the market.
Okay. Thanks, Bill. Alan, next question is for you. Throughout the webinar, we've talked about what is an angel seed funding, pre-seed, then et cetera, et cetera. Can you just really quickly draw the distinction, at least in your area, what is the distinction between angel funding and what those deals look like versus seed and kind of amounts associated with those?
Yeah, I guess everybody has different interpretations, and the real answer is that it varies based on sector and company and team background, what you truly distinguish between the rounds. In my sort of concept or my mental framework is that when you are sort of a founder, maybe you have a co-founder, and you have a bit of an idea on sort of what you want to build. That's when you maybe start to, seek out some angel funding from high net worths or your friends and family to kind of get you up and started, right? You're not, raising capital to pour into, scaling your company. You're really looking to use a little bit of that capital to build out a proof of concepts, right? That you can take it to the equity investors, the institutional investors to raise a larger round. And once you get to that point, you have a couple co-founders and you have a proof of concept, the MVP, let's call it, of what your technology will look like. And perhaps you have a couple customers that you're engaging with as a design partner. There you might have the proof points, or let's call it the ingredients, to go in for seed round financing. And in the AI world today, that seed round financing can be anywhere from $1 million to 100 million bucks if you're Jeff Bezos. So it really does vary, but that's sort of the average size is somewhere between, I would say, 2 to 5 billion. And then, once you have converted those customers and you kind of have progressed a little bit on your sort of MVP into a more of a working prototype, maybe sort of like a prototype 1.0, then perhaps it'd be a good time to entertain a Series A. And there, sort of the round sizes does kind of increase quite a bit, right? Depending on your needs. If you are a hardware company looking to actually invest this into the hardware components and the hardware engineers, perhaps you need to raise between 15 and 20 million. If you are an AI company, you simply need to the raise amount of capital to hire some software engineers. There's not really any sort of CapEx commitments. Maybe it's a little bit smaller, like 10 to 15. And so it does vary, but typically when I think about a Series A is, I would like there to be some commercial proof points, and clearly some customers who can validate the pain points that you're looking to solve and the product market fit, ideally, of what your technology is doing for their pain points.
Thanks. Um, Bill, next question is to you. The question is about insights on trends in the disease areas and indications, but kind of like I interpret it as like what's hot and what's not as far as disease areas in biopharma.
So what's hot and what's not? I think one area that's hot and is still hot is in neuro, broadly defined. I think we're seeing a lot more, the neurocognitive stuff has been around for a while, Alzheimer's, neurodegenerative disorders, Parkinson's, but now we're seeing a renewed interest and growing interest in neuropsychiatric disorders. And there's more activity there using kind of somewhat non-traditional drugs to address some of those conditions. So I think neuro continues to be interesting. Well, it is evolving a little bit. And I think there's renewed interest in immuno-oncology. It was all the rage a while ago, ran into some headwinds. And I think we're starting to see renewed interest in utilizing the body's immune system to try to deal with cancer. There's a lot of new biology coming to bear, and sort of call it third generation immuno-oncology that is starting to show real promise. I think those are probably two areas that are pretty interesting right now.
Okay. Well, that's interesting because one of the other questions we had was the financing appetite for oncology therapeutics right now. So is that particular area one of the main
Oncology,
focus?
yeah, oncology in general has always been any analysis of biopharma, venture
Yeah,
activity. Oncology is always a big chunk of it. It moves around, but it's always a big chunk, and it will be a big chunk going forward. I think it's a little bit out of favor now. And there are some other areas that are more interesting, but by out of favor, instead of being 50%, it may be 40%. But it's not. It's never not going to be a major focus of venture activity in biotech.
absolutely.
It's a faceted problem.
Yeah. Um, So, Alan, back to you. Are there any particular areas and technologies in the defense sector that has investors super excited? Obviously, it's a huge area right now. I think we're actually going to be trying to do a defense sector focused webinar later this year, but anything in particular that you are excited about in the area?
Yeah, sure. I guess maybe I'll break it down to hardware and software. I think on the hardware side, lots of interest in terms of autonomy, right? Like how do we actually, yeah, mobilize or convert sort of our sort of manned fleet into some autonomous systems for both safety and also more performant advantages. And so we actually invested in a company out of the University of Washington called Urbalin AI that is doing exactly that, autonomous warfare systems that can move on land. You're seeing similar sort of concepts emerge around marine, right, on boats, as well as aerial for planes. I think on the software side, area that we're kind of delving into a little bit, but we're still kind of working around our thesis is sort of this agentic application within the military, right? How do we automate some of the core, but also the non-core sort of workflow processes within the military with agentic applications, similar to what we're seeing in sort of the enterprise world for agentic. Some of you already probably saw what OpenClaw can do, right? Sort of on a simple Mac Mini. So, what are some of the agentic workflows that we can also take into the dual use side?
Great. Thank you, Alan. Um, Bill, Alan talked a little bit about angel investing more on the tech side. This person asks about, have we seen examples of biotech angels generating a return due to the high cost, timeline, et cetera, dilution risk? Do you see many biotech angels?
Do. I mean, I think I define angels and seed. I separate them. Angels are usually individuals, either individually investing or as groups. There are a lot of angel groups out there, and they're looking at each deal as a one-off, not so much a fund. And there are some very wealthy, ultra high net worth angels that invest in biotech, but the downstream investment requirements are so significant that typically you don't see angels investing the kind of dollars in life science that you might see in tech. But there are angels that, have an affinity, like a family member with a given condition, or for some reason they feel compelled to really try to get these early stage efforts off the ground. When we think of seed investing, usually those are investors that are institutions that invest in Series A or lead Series A in later rounds, but are making an early stage investment, as opposed to the angel groups, which really only work in that very early pre-Series A realm. And so angel and seed can certainly overlap, but we're not seeing, other than with very few exceptions, the uber high net worth angel investor putting $100 million into a company, life science. It just doesn't happen.
All right. We only have we have two more questions. We have 1 minute left. I do want to remind people to please answer the survey as you leave. It'll come up. It's also in the chat. And I do want to thank everyone for joining us today. But we do just have 1 minute left. I'm going to try to quickly ask these questions. Bill, any investment trends that we're seeing in emerging platform diagnostics or monitoring technologies? I know you already talked about the quite a bit decrease in the areas for overall in diagnostics, but anything you wanted to mention on emerging platform diagnostics or monitoring technologies?
A lot of it has to do with the application of AI and machine learning to some of these more traditional monitoring technologies, whether it's glucose and diabetes or blood pressure, non-invasive ways to monitor those and maybe integrate them into therapeutic algorithms, even a closed loop setting. I think that's where we're seeing some activity there.
Okay, great. And actually, this is a great last question to ask each of you. And apologize. There's one more question that just came in, but Matthew will follow up with you afterwards on that question because we are at time. The last question was, have there been any broad changes in the sophistication of academic spinouts? Are universities getting better at spinning out fundable companies, or are the best ideas being identified earlier by VCs and incubated in collaboration with the academic labs? I'm going to start off answering this one because I've been in the academic innovation field now for 30 some years, and it has changed leaps and bounds from when I have started, where there was a lot less focus, obviously, on the impact that potentially the technologies could have. creating far more resources, become much more business oriented with helping these technologies make it to further leaps internally at the university and either making their homes after that in established companies or spinouts. But the spinouts have become much more of a route that the universities have focused on than I would say what was more the traditional licensing route. So we have a bunch of webinars that are kind of about those particular topics and what universities have done. But that's just kind of my 2 cents. Alan and Bill, anything you want to add to that area?
Just quickly, in biopharma, we are seeing some of the universities taking the seminal discovery or science further before looking to license it or develop a company. So they're doing some of those translational experiments themselves, trying to do some of that work, even with an affiliated CRO, but getting further down the road of kind of drug discovery, drug development than just, hey, here's an interesting target, and we've got some ideas on like where we want to go with this, but it's, gone from that to something much more tangible. Not quite at the level or the robustness that we see in a commercial setting, but far more advanced than 10 years ago.
Yeah, and I would say that over the last 2 years, I've been seeing a tremendous amount of interest from the investor community in engaging upstream with academia. There's just a lot more value being placed on the PhDs in terms of the deep science and the actual technology breakthroughs they're developing, and also willingness from industry to partner with those academics in spinning out companies.
Great. Well, thank you. Thank you both for being here today, for taking the time to run through all of this data with everyone. I know it always generates a lot of questions. I'm sure we'll have some more coming in. Really appreciate you guys taking the time. And I would thank your audience for showing up today, asking such terrific questions. Always feel free to reach out to us for any of these types of questions. We're really happy to be working with all of you. So everyone enjoy the rest of their day.